Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not intended as financial or legal advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. Let's talk about that piece of mail. You know the one. It arrives every 6 months like clockwork. Your auto insurance bill. You open it, maybe with a little bit of dread, and your heart sinks. The number has gone up. Again. You rack your brain. Did you get a ticket? No. An accident? Haven't had one in 20 years. In fact, you're driving less now than ever before. You're retired. You're not commuting in rush hour traffic 5 days a week. You use the car for groceries, for visiting the grandkids, for the occasional road trip. So you're a safer, lower mileage driver. Yet your reward is a higher premium. Feels completely backward. Feels unfair. It feels like you're being penalized for your loyalty, penalized for your age, and penalized for reasons nobody can seem to explain. You are not imagining it. And you are not alone. Millions of American seniors are in the exact same boat, paying hundreds, sometimes thousands of dollars more than they should be, simply because the insurance game has changed and nobody has given them the new rulebook. Well, consider this your new rulebook. Over the next several parts of this guide, we are going to pull back the curtain on the auto insurance industry. I am going to arm you with the knowledge, the language, and the strategies you need to stop overpaying and start getting the respect and the rates you deserve. This isn't about finding a flimsy $10 a month policy with no coverage. This is about understanding your true value as a mature, experienced driver and making the system work for you, not against you. We will transform you from a passive bill payer into an empowered, informed consumer who can confidently negotiate and secure the best possible coverage at the lowest possible price. By the end of this series, you will know more about senior auto insurance than 99% of the population, and you will have a clear step-by-step plan to potentially slash your premiums by 20, 30, or even 50%. The single biggest mistake most people make, especially as they get older, is thinking that car insurance is just about one thing, the price. They shop for the cheapest quote, sign on the dotted line, and forget about it. That is a trap. For seniors, auto insurance is not just about price. It's about alignment. It's about aligning your policy with your actual life right now. The policy that made sense for you when you were 45 driving 30,000 miles a year to and from a high-pressure job is almost certainly the wrong policy for you today. Your life has changed. Your driving habits have changed. Your risk profile has changed. So why hasn't your insurance policy changed with you? The answer is simple. Inertia. Insurance companies thrive on it. They are banking on the fact that you're busy, that you find the whole process confusing, and that you'll just keep paying the bill out of habit. In fact, they have a name for this. It's called price optimization. It's a quiet, little-known industry practice where companies use sophisticated data analysis to figure out which customers are least likely to shop around for a better deal. And guess who often falls into that category? Loyal long-term customers. They identify you as someone who is unlikely to leave, and they slowly, incrementally, raise your rates year after year. They are, in essence, charging you a loyalty tax. The very thing you thought was earning you a discount, sticking with the same company for a decade or more, is often the primary reason you're being overcharged. So, the first and most crucial step in this journey is a mental one. You have to break the loyalty myth. You owe your insurance company nothing more than the premium you pay them. Your relationship is a business transaction, period. And right now, you might be on the losing end of that transaction. It's time to flip the script. Let's start by redefining who you are as a driver. For years, insurance companies have lumped older drivers into a single high-risk category, using outdated actuarial tables that don't reflect modern reality. But the data tells a different story. Mature drivers as a group are often some of the safest on the road. Think about it. You have decades of driving experience. You're less likely to be texting and driving. You're less likely to be speeding or driving aggressively. You avoid driving late at night, in bad weather, or during chaotic rush hours. You are, by many objective measures, a model customer, an ideal client. The problem is, your insurance company won't recognize this unless you force them to. They won't volunteer the discounts you're entitled to. You have to know what to ask for. You have to advocate for yourself. And that advocacy starts with understanding your new leverage points. Your greatest asset is no longer just a clean driving record. It's your entire lifestyle. The fact that you've retired is a massive leverage point. The fact that your annual mileage has likely been cut in half, or even more, is a massive leverage point. The fact that you garage your car, that you've taken a defensive driving course, that your car is filled with modern safety features. These are all powerful bargaining chips. But they're useless if you don't know how to play them. Most people call their agent and ask a simple passive question. Can you get me a lower rate? That's the wrong question. It gives all the power to them. The right approach is to call with a specific, informed demand. I am a low-mileage driver with over 40 years of experience. I've completed a state-approved mature driver safety course, and my vehicle has an anti-lock braking system and electronic stability control. I expect my policy to reflect the significantly lower risk I represent. I want to see the specific discounts for these items broken down on my quote. See the difference? One is a hopeful plea. The other is an informed command. It signals to the company that you are not an easy target for price optimization. It shows them you've done your homework. Throughout this guide, we are going to build on that foundation. We will deconstruct your insurance policy line by line so you understand exactly what you're paying for. We'll explore coverages you might not need anymore, like high levels of rental reimbursement or towing, and other coverages you might want to add, like medical payments coverage, which can be critical on a fixed income. We will create a master checklist of every conceivable discount available to senior drivers in the United States, from the well-known to the obscure. We'll talk about the pros and cons of telematics, those little devices or apps that track your driving, and whether they are a good fit for you. We will even discuss the difficult but important topic of when it might be time to transition away from driving, and how that impacts your insurance needs. This is a complete masterclass designed to save you money, reduce your stress, and give you unshakable confidence the next time that bill arrives in the mail. So let's get started on the first step: understanding the fundamental types of coverage and figuring out what you actually need. Think about the last time you looked at your auto insurance policy declaration page. It's a wall of text, isn't it? Full of confusing terms like bodily injury liability, comprehensive, PIP, and a bunch of numbers that seem totally random. Feels like trying to read a foreign language. But here's the secret. It's not that complicated once someone translates it for you. And that's what we're going to do right now. We're going to turn that confusing document into a simple, powerful tool you can use to protect yourself and your savings. Let's start with the absolute bedrock of any auto insurance policy: liability coverage. This is the one that's not really for you. It's for everyone else. Liability is what pays for the damage you cause to other people and their property if you're at fault in an accident. It's so important, it's legally required in nearly every state. It's usually broken into two parts. First, you have bodily injury liability. Imagine you're at a four-way stop, you think it's your turn, but you misjudge it and pull out, causing a collision. The other driver ends up with a broken arm and whiplash. Your bodily injury liability is what pays for their medical bills, their lost wages from being out of work, and potentially their pain and suffering. It's typically shown as two numbers, like 2550. This means your policy would pay up to $25,000 for one person's injuries, and a maximum of $50,000 for all injuries in a single accident, no matter how many people are hurt. The second part is property damage liability. In that same accident, you didn't just hurt the other driver. You crumpled the entire side of their brand new SUV. Your property damage coverage pays to repair or replace their vehicle. It also covers damage to other property, like if you backed into a neighbor's fence or a storefront. This is the third number you see in that sequence, so a policy might read 25/50/25. Now, here is the most important piece of advice I can give you about liability. The state minimum requirement is almost never enough. Many states have minimums as low as 25/50/25 or even less. Think about it. $25,000 for a hospital stay? In today's world, that can be gone in a single day. And $25,000 for property damage? The average price of a new car is over $45,000. If you total someone's new car, or heaven forbid, cause a multi-car pileup, that state minimum coverage will be exhausted in a heartbeat. And when the insurance money runs out, where do you think they'll look next? They'll look to your assets, your savings, your retirement accounts, even your home. Opting for higher liability limits like 100/300/100 is one of the cheapest ways to buy incredible peace of mind and build a financial fortress around the nest egg you've worked your entire life to build. Okay, so that's the coverage for other people. What about you and your car? That's where the next two types of coverage come in: collision and comprehensive. Let's talk about collision first. It's exactly what it sounds like. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. This could be another car, or it could be a pole, a guardrail, or a tree. The key thing to remember is that it covers damage when your car is in motion and hits something. It doesn't matter who is at fault. If you cause the accident, collision pays for your car. If someone else hits you, their liability coverage should pay, but if they don't have enough, or if there's a dispute, you can still use your own collision coverage to get your car fixed quickly, and your insurance company will then go after the other driver's company for reimbursement. When you buy collision, you'll choose a deductible. This is the amount you pay out of pocket before the insurance kicks in. A common deductible is $500 or $1,000. A higher deductible means a lower premium, because you're taking on more of the initial risk yourself. Now, for seniors, this is where a critical decision comes in. If you're driving a 15-year-old car that's paid off and maybe worth $2,000 or $3,000, does it make sense to pay for collision coverage? You might be paying a few $100s a year for a policy with a $1,000 deductible to protect a $2,000 car. In that case, the most the insurance company would ever pay you is $1,000. For many, it makes more financial sense to drop collision on an older vehicle and essentially self-insure, meaning you'd save that premium money in a separate account to use for repairs or a down payment on a new car if needed. But if your car is newer, or if you have a loan or lease, collision is an absolute must-have. Next up is comprehensive coverage. I like to call this the act of God and everything else coverage. While collision covers you when you hit something, comprehensive covers almost everything else that can damage your car when you're not driving. A tree branch falls on it during a storm. A deer runs out and you hit it. Your car is stolen. It's vandalized. It's damaged by hail, a fire, or a flood. All of these scenarios fall under comprehensive coverage. Like collision, you'll also have a deductible for comprehensive. And just like with collision, you have to ask yourself if it's worth it for your specific situation. Do you live in an area prone to hailstorms, floods, or hurricanes? Is car theft common in your neighborhood? Do you park your car outside under a giant oak tree every night? If so, comprehensive can be a lifesaver. If you have a brand new car, it's essential. But if you have that same 15-year-old car and live in a very safe area with a garage, you might consider the math just as you did with collision. The key is to make an informed decision, not just accept the default policy. Now we move on to one of the most underrated but critically important coverages you can have: uninsured and underinsured motorist coverage. Let's be honest, we all follow the rules. We pay for our insurance because it's the responsible thing to do. But not everyone does. It's estimated that 1 in 8 drivers on the road in the United States has no insurance at all. That's a scary number. So what happens if one of those drivers runs a red light and plows into you, sending you to the hospital? They have no insurance to pay your medical bills. They have no insurance to repair your car. You could sue them personally. But the reality is that someone driving without insurance probably doesn't have significant assets to collect. You could be left with mountains of debt for an accident that wasn't even your fault. This is where uninsured motorist coverage steps in. It acts like the other driver's insurance policy when they don't have one. It will pay for your medical expenses and in some states for your car repairs too. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover all of your bills. Remember that guy with the state minimum 25/50ths policy? If your medical bills are $100,000, his insurance pays the first $25,000, and then your underinsured motorist coverage can kick in to help cover the rest, up to your policy limits. This coverage is you protecting yourself from the irresponsibility of others. I cannot recommend it highly enough. Finally, let's quickly touch on medical payments coverage, or MedPay, and personal injury protection, or PIP. These are related, and which one is available depends on your state. They are designed to pay for medical expenses for you and your passengers after an accident, regardless of who is at fault. It's primary coverage, meaning it pays out right away before any health insurance. This can be fantastic for covering your health insurance deductible, copays, or treatments that your health plan might not cover, like chiropractic care. For seniors on Medicare, this is an important point. MedPay can often fill the gaps that Medicare leaves you to pay. PIP is a broader version required in no-fault states, and it can also cover things like lost wages and other rehabilitation services. So let's recap. We've decoded the core language of your policy. Liability protects your assets by covering damage you cause to others. Collision and comprehensive protect your own vehicle from accidents and other types of damage. An uninsured motorist and MedPay protect you and your own body from other drivers and from unexpected medical costs. You now understand the what. You know what each of these building blocks of insurance is designed to do. But this leads us to the next and arguably most important question. How much? How much of each is the right amount for you? How do you pick the right numbers, the right limits, and the right deductibles so you're not overpaying for coverage you don't need, but you're also not leaving yourself dangerously exposed? That is the million-dollar question, and it's exactly what we are going to break down step by step in the very next part. So let's answer it. Choosing your deductible isn't a game of chance. It's a strategic decision about risk, and it's one of the most powerful levers you have to control your monthly insurance premium. The first thing you need to understand is the fundamental relationship at play here. Think of your deductible and your premium as two kids on a seesaw. When one goes up, the other must come down. A high deductible, the amount you pay out of pocket in a claim, pushes your monthly premium down. A low deductible pushes your monthly premium up. The insurance company is basically asking you, how much of the initial risk are you willing to take on yourself? The more risk you agree to take by choosing a higher deductible, the more they'll reward you with a lower price. The less risk you take, the more you have to pay them for that peace of mind. So where do you set the bar? The single most important factor, the absolute bedrock of this entire decision, is your emergency fund. I want you to pause and think about this for a moment. How much cash do you have right now set aside in a savings account that you could access tomorrow without selling stocks or cashing in a retirement account? That number is your guide. Your auto insurance deductible should never, ever be higher than what you can comfortably pay from your emergency savings without it causing a major financial crisis. If you have a $1,000 deductible but only $500 in savings, you don't really have a $1,000 deductible. You have a $500 deductible and a $500 financial emergency waiting to happen. For seniors on a fixed income, an unexpected, large expense can be devastating. This isn't just about fixing a car. It's about protecting your entire financial stability. Let's make this real with a story about two different retirees, Barbara and Frank. Barbara is a retired school principal. Over the years, she was diligent about saving. She has a healthy emergency fund of about $15,000. She drives a reliable 3-year-old SUV that she loves and depends on for visiting her grandkids. For Barbara, a higher deductible makes a lot of sense. She might choose a $1,000 or even a $1,500 deductible. Why? Because she knows if she gets into an accident, writing a check for that amount, while not fun, won't derail her budget. It won't force her to skip a mortgage payment or dip into her grocery money. In exchange for taking on that manageable risk, she saves a significant amount on her premium every single month. Money she can use for travel, hobbies, or just added security. Now let's look at Frank. Frank worked at a local factory for 40 years. He gets by comfortably on his pension and Social Security, but his budget is much tighter. His emergency fund is closer to $2,000, and that's his safety net for everything. A leaky roof, a broken furnace, or a medical bill. For Frank, a $1,000 deductible would be a catastrophic gamble. A single fender bender could wipe out half of his entire life savings, leaving him incredibly vulnerable. So Frank makes the smarter choice for his situation. He opts for a lower deductible, say $250 or $500. Yes, his monthly premium is a bit higher than Barbara's. He pays a little more each month. But what he's really buying is certainty. He's buying the absolute peace of mind that comes from knowing that the worst-case scenario for a car repair is a predictable, manageable $500 expense, not a budget-busting disaster. So are you a Barbara or a Frank? Or somewhere in between? Here's how you find your personal sweet spot. Step 1 is that emergency fund reality check we talked about. Be brutally honest with yourself about what you have liquid and accessible. Step 2, call your insurance agent or go online and get quotes for different deductible levels. Don't just guess. Ask for the specific price for a $250, a $500, a $1,000, and a $1,500 deductible on both your collision and comprehensive coverages. Write these numbers down. Now for step 3, the most important part. Do the break-even math. Let's say raising your deductible from $500 to $1,000 saves you $20 a month. That's a savings of $240 per year. Now ask yourself this. Is saving $240 a year worth taking on an extra $500 of risk? To break even on that decision, you would need to go just over 2 years without an accident where you are at fault. If you have an accident in that time, you've lost the gamble. You'll pay the extra $500 out of pocket, wiping out more than 2 years of your premium savings. Are you comfortable with those odds? If the savings were, say, $50 a month or $600 a year, the math changes. You'd break even in less than a year. That might be a risk you're willing to take. This simple calculation transforms the decision from a vague guess into a clear, data-driven choice based on your personal risk tolerance. There are a couple of other crucial factors for seniors to consider. One is the value of your vehicle. Let's say you drive an older, but perfectly reliable 15-year-old sedan. It runs great, but its actual cash value, what an insurance company would pay you if it were totaled, is only, say, $2,000. Does it make sense to pay for a policy with a $1,000 deductible for collision coverage? Think about it. You're paying a premium every month for a policy that, in a worst-case scenario, would only pay you a maximum of $1,000. The full value is $2,000, minus your $1,000 deductible. In this case, the cost of the coverage might outweigh the potential benefit. You might be better off with a higher deductible or, as we'll discuss later, even dropping collision coverage altogether and self-insuring the risk of damage to your own vehicle. Finally, don't discount the psychological component. This isn't just about the numbers on a spreadsheet. It's about what lets you sleep at night. If you are someone who worries constantly about finances, and the thought of a surprise $1,000 bill would cause you immense stress and anxiety, then a lower deductible is worth every extra penny in your premium. That premium isn't just for car repair. It's for your mental well-being. Peace of mind has real value, especially in retirement. So, you've assessed your emergency fund. You've done the break-even math. You've considered your car's value and your own personal comfort with risk. You now have a rock-solid strategy for choosing the right deductible. You've mastered the how much do I pay part of the equation. But this deductible applies to different types of coverage. What are they? What is the difference between liability, collision, and comprehensive coverage? Do you actually need all of them, especially if you have an older car or you barely drive? Getting this wrong means you could be paying for coverage you don't need, or worse, be missing a coverage that's absolutely essential. Nailing down these core coverage types is the next critical piece of building your perfect, cost-effective policy, and that is exactly what we are breaking down next. Let's think of your auto insurance policy not as a single, confusing document, but as a protective shield you build piece by piece. Each piece has a specific job, and understanding them is the key to creating a shield that's strong where you need it, without weighing you down with unnecessary costs. The absolute foundation, the piece of the shield that is legally required in nearly every state, is liability coverage. This isn't for you, it's for them. It's for the other people you might injure, or the property you might damage in an accident where you are at fault. Liability is broken into two parts. First, there's bodily injury liability. Imagine you're at a four-way stop. You believe it's your turn, you proceed, and suddenly you're in a collision with another car. The other driver and their passenger suffer injuries. They have medical bills, they miss work, and they experience pain and suffering. Your bodily injury liability coverage is what steps in to pay for their costs, up to the limits you've chosen. Second, there's property damage liability. In that same accident, you didn't just injure the people, you badly damaged their brand new SUV. Your property damage liability is what pays to repair or replace their vehicle. It also covers any other property you might damage, like if you swerved and hit a neighbor's mailbox or a city light pole. Now, here is the single most important piece of advice about liability. State minimums are a trap. Every state has a minimum amount of liability coverage you're required to carry. It might be something like 25/50/25. That means $25,000 for bodily injury per person, $50,000 total for bodily injury per accident, and $25,000 for property damage. Sounds like a lot of money until it isn't. A single night in a hospital can cost more than $25,000. A modern car with all its sensors and technology can easily cost more than $25,000 to replace. If you cause an accident where the costs exceed your liability limits, where do you think the other party's lawyers are going to look for the rest of the money? They're going to look at your assets, your savings, your investments, the equity in your home. Everything you've worked your entire life to build could be at risk because you tried to save a few dollars a month by sticking with the state minimum. For seniors, protecting your nest egg is paramount. This is not the place to skimp. Raising your liability limits is often one of the cheapest and most important upgrades you can make to your policy. So, liability covers the other guy. But what about you and your car? That's where the next two pieces of the shield come in. Collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, Or it could be a pole, a fence, a guardrail, or even your own garage door. It doesn't matter who is at fault. If you collide with something, this is the coverage that fixes your car. Comprehensive coverage is a bit different. Think of it as everything else coverage. It protects your car from damage not caused by a collision. This includes things like theft, vandalism, fire, falling objects like a tree branch, hail, flooding, or hitting an animal like a deer. It's for the unpredictable events in life. Now, for seniors, the decision to carry collision and comprehensive is a major one, and it comes down to simple math. These coverages are optional if you own your car outright. So you have to ask yourself, what is my car worth? Not what you paid for it, but its actual cash value right now. You can get a good estimate from sites like Kelley Blue Book. Let's say your trusty 12-year-old sedan is worth $4,000. You have a $1,000 deductible for both collision and comprehensive. That means if you get into an accident, the most the insurance company will pay out is $3,000. Now, how much are you paying per year for that coverage? If it's $600 a year for both, you're paying a significant portion of the car's potential payout every single year. At some point, it might make more sense to drop these coverages, take the money you were spending on the premium, and put it into a dedicated savings account for car repairs or a down payment on your next vehicle. You'd be self-insuring. However, if your car is newer, or if you simply don't have the cash on hand to go out and buy a replacement vehicle tomorrow, then keeping collision and comprehensive is essential for your financial security and mobility. It's a personal calculation of risk versus cost. Okay, so we've covered your liability to others and we've covered damage to your own car. But there's a huge gaping hole in our shield. What happens if someone hits you and they don't have insurance, or they have that bare-bones state minimum policy that we just talked about? This is where uninsured and underinsured motorist coverage comes in, and frankly, it is one of the most vital protections you can buy. Statistics show that as many as 1 in 8 drivers on the road is uninsured. That's a terrifying number. If one of them hits you and causes serious injury, their lack of insurance becomes your crisis. Uninsured motorist coverage steps in and acts like the at-fault driver's insurance. It pays for your medical bills, your lost wages if you have a part-time retirement job, and your pain and suffering. Underinsured motorist coverage does the same thing if the at-fault driver has insurance, but their liability limits are too low to cover all of your medical expenses. Without this coverage, you could be left to rely solely on your own health insurance, facing massive deductibles and copays, and you'd get nothing for your pain and suffering. This coverage is your shield against the irresponsibility of others, and it is an absolute must-have. Finally, let's talk about the immediate aftermath of an accident. Regardless of who is at fault, there are often immediate medical costs. An ambulance ride, an emergency room visit, a few x-rays. This is where medical payments coverage, or MedPay, comes in. Some states have a more comprehensive version called Personal Injury Protection, or PIP. Think of MedPay as a small pot of goodwill medical money. It typically offers a few $1,000s in coverage, say $5,000 or $10,000, that pays for initial medical and even funeral expenses for you and your passengers, no matter who caused the accident. It pays out quickly, without waiting for the insurance companies to fight over who's at fault. Why is this so important for seniors? Because it can cover your health insurance deductible and copays. If you have a high-deductible health plan, a single ambulance ride and ER visit could leave you with a multi-$1,000 bill. MedPay can wipe that out instantly, protecting your cash flow and preventing a medical bill from becoming a financial emergency. It's relatively inexpensive and provides incredible peace of mind. So let's recap the core shield we've just built. We have liability to protect your life savings from others. We have collision and comprehensive to protect the value of your own vehicle. We have uninsured and underinsured motorists to protect you from irresponsible drivers. And we have MedPay or PIP to cover your immediate medical costs and fill the gaps in your health insurance. These are the big 5. Getting these right, choosing the right limits and the right deductibles, is 90% of the battle. It's the difference between a policy that's a real safety net and one that's full of holes. But our shield isn't quite complete. There are a few other, highly valuable and often surprisingly affordable, add-ons that can make life dramatically easier after an incident. Things like roadside assistance tailored for seniors, or ensuring you're not left without a car while yours is in the shop. These are the finishing touches that turn a good policy into a great one, and we're going to explore those powerful options next. Let's talk about building a safety net so strong, it catches you before you even realize you're falling. These optional coverages, these add-ons, are the steel cables in that net. They're not frills. They are strategic decisions that protect your independence and your peace of mind. First up, let's tackle one of the most common and frankly most valuable options: roadside assistance. Now, I know what some of you might be thinking. I have a new car, it's reliable, or my son-in-law can help me out. But let's paint a picture. It's 9 o'clock at night. You're driving home from a late dinner with friends on a stretch of highway you don't know very well. Suddenly you hear it. That dreaded thump-thump-thump of a flat tire. You pull over to the shoulder, cars whizzing by, headlights blinding you. In that moment, are you going to get out the jack and try to change a tire in the dark? For most of us, the answer is a hard no. It's not just inconvenient, it's a safety issue. This is where roadside assistance becomes your guardian angel. It's not just for towing, it's for the flat tire. It's for when you accidentally leave the lights on and your battery is dead in the morning before a doctor's appointment. It's for that sinking feeling when you realize you've locked your keys inside your car at the grocery store. With one phone call, help is on the way. You stay safe in your locked car, and a professional handles the problem. For a few extra dollars a month, you are buying the certainty that you will never be stranded and vulnerable. It's a direct investment in your personal security and independence, ensuring a minor car problem doesn't turn into a major crisis. Next, let's talk about something people rarely think about until it's too late: rental reimbursement coverage, sometimes called loss of use. Imagine you're in a minor fender bender. No one's hurt, thank goodness, but your car needs to go to the body shop. The mechanic says it'll take about 3 days. But then he calls back. "We're having trouble getting the right part," he says. "It's backordered. It might be 2 weeks. 2 weeks. Suddenly, your entire life grinds to a halt. How do you get to your physical therapy appointments? How do you pick up your prescriptions? How do you visit your grandkids? You're faced with a choice. Rely on friends and family, which can feel like a burden, or spend hundreds, maybe even thousands of dollars on Ubers or a rental car out of your own pocket. Rental reimbursement coverage prevents this nightmare. For a very small addition to your premium, your insurance company will pay for a rental car while yours is being repaired after a covered claim. They typically have a per-day limit, like $30 or $50 a day, and a total limit, like $900 or $1,500. This single piece of coverage ensures that an accident doesn't just damage your car. It doesn't immobilize your life. You maintain your freedom, your routine, and your dignity, all because you planned ahead. Now, for anyone with a newer car that has a loan on it, we need to have a serious conversation about gap insurance. This is one of the most misunderstood but critically important coverages you can buy. Here's how it works in the real world. You decide to treat yourself in retirement to a brand new, safe, reliable car. You finance $35,000 to buy it. The moment you drive it off the lot, it starts to depreciate. That's just a fact of life. 6 months later, you're in an accident and your beautiful new car is declared a total loss. Your insurance company does its job. They look at the market value of your 6-month-old car, its actual cash value, and they write you a check for $29,000. But here's the gut punch. You still owe the bank $34,000 on your loan. So, not only do you have no car, but you now have to write a check for $5,000 to the bank for a car that no longer exists. It's a devastating financial trap. Gap insurance is what fills that gap. It pays the difference between what your car is worth and what you still owe on your loan or lease. It's the financial airbag that protects you from being upside down after a total loss. If you have a loan or a lease on your vehicle, especially a new one, gap insurance isn't a luxury. It's an absolute necessity to protect your savings. Let's move on to something more specific but equally important for some folks: custom parts and equipment coverage. Your standard auto policy is designed to cover the car as it came from the factory. But what if you've made changes? We're not just talking about fancy rims or a high-end stereo. For many seniors, this is about vital accessibility modifications. Think about someone who has invested $10,000 to equip their van with a wheelchair lift and hand controls. These modifications are what allow them to maintain their mobility and freedom. If that van is in an accident, a standard policy will only pay to repair or replace the factory version of the van. It will not cover that $10,000 lift or the custom controls. All that investment, all that freedom would be gone. Custom parts and equipment coverage is the add-on that specifically protects these valuable and necessary modifications. If you have altered your vehicle in any significant way, you need to talk to your agent about this coverage to ensure you're fully protected. Finally, let's look at a cousin to gap insurance called new car replacement coverage. This is for those who buy a brand new car and want the ultimate peace of mind. We already talked about depreciation. If your brand new car is totaled a year after you buy it, the insurance company will pay you what it's worth now, which is thousands less than what you paid for it. That settlement check might not be enough to go out and buy the exact same car brand new again. New car replacement coverage solves this. If your car is totaled within a certain time frame, usually the first 1 or 2 years, and under a certain mileage, this coverage won't just give you the depreciated value. It will give you enough money to buy a brand new car of the same make and model. It essentially erases that first-year depreciation hit. It's the ultimate do-over button, ensuring that a total loss early in your car's life doesn't result in a major financial step backward. As you can see, these options are far from minor details. They are powerful tools. Roadside assistance is your safety patrol. Rental reimbursement is your guarantee of continued mobility. Gap and new car replacement are your shields against devastating financial loss. And custom equipment coverage protects the very tools that might be essential to your daily life. Building the right policy is about looking at your specific life, your car, and your needs, and then handpicking the exact protections that let you live without worry. Now that we've built the perfect fortress of coverage, how do we make it affordable? The good news is, there's a treasure trove of discounts specifically available to senior drivers, and unlocking them is easier than you think. We're about to reveal the secrets to slashing your premium without sacrificing a single bit of this crucial protection. Let's start with the biggest and most powerful discount, the one you've earned over decades: your driving record. Insurance companies are obsessed with data. They're number crunchers, and their data tells them one thing loud and clear. Experienced drivers who have maintained a clean record are the safest bet on the road. They are a gold standard risk. This isn't a favor they're doing for you. It's a business decision. You are less likely to file a claim and they want your business. The Good Driver Discount, or Safe Driver Discount, can slash your premium by up to 30%. Think about that. For a $2,000 annual premium, that's $600 back in your pocket, just for doing what you've always done: driving safely. But here's the secret. Many insurers don't automatically apply the maximum discount. Sometimes you have to ask. You have to remind them of your value. When you call, don't just ask if you have the discount. Say this: I'd like to confirm I'm receiving the maximum possible safe driver discount. I've been licensed for over 40 years and have had no at-fault accidents in the last decade. That specific phrasing changes the conversation. You're not just a policy number. You're a prime customer and you know it. Now let's talk about the single best investment of a few hours of your time that could save you hundreds of dollars a year. It's the Mature Driver Improvement Course. You might hear it called a defensive driving course. And I know what you might be thinking. A driving class? I've been driving longer than the instructor has been alive. And you're probably right. But this isn't about teaching you how to drive. This is about playing the insurance game and winning. States across the country have mandated that insurance companies must provide a discount, typically between 5 and 15%, to seniors who complete an approved course. These aren't the boring 8-hour in a stuffy classroom courses of the past. Today you can take them online from the comfort of your own home at your own pace. You can do a chapter, go have a cup of coffee and come back. The course itself often costs less than $50. So you spend $50 and a few hours of your time to get a discount that could save you $150 or more every single year for the next 3 years. The return on investment is staggering. It's one of the easiest, most guaranteed ways to lower your bill. Companies like AARP and AAA offer incredibly popular, easy-to-follow online courses specifically designed for senior drivers. It's a no-brainer. Next, let's talk about how your life has changed and why your insurance should change with it. Are you still commuting to work every day? Battling rush hour traffic? For most retirees, the answer is a resounding no. Your car's primary job has changed. It's no longer a workhorse. It's for pleasure, for errands, for visiting family. This is a massive deal to an insurance company. The single biggest factor in your rate, after your driving record, is how many miles you drive per year. If you're driving less than 7,000 or 8,000 miles a year, you qualify for a significant low-mileage discount. But you have to tell them. Your insurer won't magically know you've retired. They'll just keep charging you the same commuter rate you've been paying for years. You need to pick up the phone and declare that your driving habits have changed. Tell them your estimated annual mileage. This one change alone can result in a discount of 10 to 20%. It's a retirement dividend you've earned. You've put in the years of hard work and long commutes. Now it's time to cash in on the savings that come with a more relaxed lifestyle. But the discounts don't stop there. We're just getting warmed up. Let's talk about who you are and the groups you belong to. Are you a member of an organization like AARP? That membership isn't just for travel deals and magazines. AARP has a long-standing partnership that provides its members with special rates on auto insurance. Are you a veteran or active duty military? Organizations like USAA offer some of the best rates in the country, exclusively for service members and their families. Did you graduate from a university? Many alumni associations have partnerships with insurance carriers to offer group discounts. The same goes for certain professional organizations, credit unions, and even wholesale clubs. Think about the groups you're a part of. It's like having a secret key to a vault of savings. These are called affinity discounts. Insurers offer them because their data shows that members of these groups tend to be more responsible and file fewer claims. It's another statistical advantage. Make a list of every organization you belong to. When you talk to your insurance agent, go down that list and ask, "Do you offer a discount for members of this group?" You will be shocked at how much found money is waiting for you. Now let's look at the car itself. Your vehicle is a rolling package of safety features, and each one can be a potential discount. Does your car have anti-lock brakes? That's a discount. Airbags? That's a discount. Automatic seatbelts? Daytime running lights? An anti-theft system? Discount, discount, discount. Many of these are standard on modern cars, but you'd be surprised how often they aren't automatically factored into your premium. You need to make sure your insurer has an accurate and complete list of every safety and anti-theft feature on your vehicle. Don't assume they know. Verify it. Each one might only be a few percentage points, but this is a game of inches. And those inches add up to yards of savings. Finally, there's the big one, bundling. Insurance companies want as much of your business as they can get. They don't just want to insure your car. They want to insure your home, your life, your boat, your RV. And they are willing to pay you handsomely for that loyalty. Bundling your auto insurance with your homeowner's or renter's insurance policy is almost always the single largest discount you can get, sometimes as high as 25% off of both policies. It simplifies your life, one company, one bill. And it saves you a substantial amount of money. If your home and auto policies are currently with different companies, you are almost certainly leaving hundreds of dollars on the table. It's the first thing you should look into. And while you're at it, ask about a loyalty discount. If you've been with the same company for 3 years, 5 years, 10 years or more, you deserve to be rewarded for that loyalty. Combine a loyalty discount with a bundling discount, a safe driver discount, a defensive driving course discount, and a low mileage discount, and you see the picture? You're not just chipping away at the price. You're fundamentally changing your premium. You're taking control. You're combining 5 or 6 different discounts that, when stacked together, can cut your bill in half. This isn't a fantasy. This is the reality for informed senior drivers who know which levers to pull. So now you have the knowledge. You have the checklist of discounts. You know where the secret savings are hidden. But knowing the combination to the safe is one thing. Actually walking up, turning the dial, and opening the door is another. What do you say when you get your agent on the phone? How do you negotiate from a position of strength? And what happens if your current company just won't budge? In the next part, we're going to arm you with the exact scripts and strategies to use, turning this knowledge into a powerful tool that puts cash back into your wallet. We're about to turn you into the kind of customer insurance companies are afraid to lose. And it starts not with anger or frustration, but with preparation. The most powerful negotiator is the one who has done their homework. So before you even think about picking up the phone, we are going to build your personal negotiation toolkit. Think of it as your insurance dossier. A file that contains everything you need to win. First, you need your current policy's declaration page. This is non-negotiable. It's the single most important document in this entire process. Find it, print it out, and get a highlighter. This page lists every single coverage you have, the limits for each, and your deductibles. It's the blueprint of what you're currently paying for. You need to know it inside and out. What are your liability limits? Is it 100,000, 300,000, 500,000? What's your deductible for collision? Is it $500? $1,000? You can't ask for a better deal if you don't know what your current deal even is. Second, you need at least 3 fresh quotes from competing insurance companies. And I mean full apples-to-apples quotes. Use the declaration page you just found to request the exact same coverage levels from at least 3 other major insurers. This is your leverage. Calling your insurance company without competitive offers is like going to a gunfight with a water pistol. You have no power. With these quotes in hand, you are no longer just asking for a discount. You are showing them in black and white what their competition is willing to do to earn your business. This transforms the conversation from a plea into a business decision for them. Third, create a checklist of every potential discount we've discussed in this series. Go back and rewatch if you need to, but write them down. Senior discount, low mileage discount, defensive driving course discount, bundling home and auto, good student discount for a grandchild on your policy, safety features on your car like anti-lock brakes or an alarm system. Make a physical list. During the call, you will go down this list one by one to ensure you're not leaving a single dollar on the table. Finally, know your numbers. Based on the competitor quotes, determine your goal. What is the premium you want to pay? Also, determine your walk-away number. At what price is it simply no longer worth staying with your current company? Having this clarity prevents you from getting flustered or accepting a mediocre offer just to end the call. Okay, you've got your dossier. Your declaration page is highlighted, your competitor quotes are printed out, your discount checklist is ready, and you know your target price. Now it's time to make the call. Take a deep breath. Remember, you are in control. You are a valued long-term customer, and they don't want to lose you. When you call, you'll likely get an automated system. Navigate it to get to a representative who can discuss your policy and billing. Once you have a live person on the line, here is your opening script. Be calm, be polite, but be direct. Hi, my name is your name, and my policy number is your policy number. I've been a loyal customer with your insurance company for a number of years, and I'm calling today to review my auto insurance policy. My renewal is coming up, and the proposed premium seems quite a bit higher than I was expecting, so I'd like to see what options are available to lower it. This opener does three critical things. It identifies you, it immediately establishes your long-term loyalty, which is a keyword for them, and it clearly states your purpose. No small talk, no beating around the bush. Now the agent will pull up your policy and likely give you a generic, pre-scripted response like, well, rates have been increasing everywhere due to inflation and repair costs. This is where you deploy your leverage. Your response should be, I certainly understand that costs are rising. That's why I've been doing some due diligence. I've actually received a few quotes from other reputable companies for the exact same coverage I have with you now. For example, competitor company 1 has quoted me at price, and competitor company 2 came in at price. That's a difference of about. Calculate the difference per year. Now, I'd much rather stay with you. I've been happy with the service for a number of years. So, I'm calling to see if you can match that price, or at least get closer to it so I have a reason to stay. See what you did there? You acknowledged their point, but you immediately pivoted to your own research. You name names and you name numbers. This shows you are serious. And you ended with a collaborative, positive tone. You're not threatening to leave. You're asking them to help you stay. This is a crucial psychological shift. It makes the agent your partner in problem solving, not your adversary. Now the agent will likely put you on hold while they see what they can do. When they come back, they might offer you a small initial discount. This is just their first move. This is where you pull out your discount checklist. You say, thank you, I appreciate you looking into that. To make sure we're getting the absolute best rate possible, could we quickly run through my discounts? I want to confirm I have everything I'm eligible for. First, am I receiving the senior or mature driver discount? Okay, and what about a low mileage discount? I only drive about 6,000 miles a year. Great. My car has anti-lock brakes and passive restraints. Are those discounts applied? I also have my homeowner's insurance with you, so the bundle discount should be there. Can you confirm that? And I recently completed a certified defensive driving course. I have the certificate here. Is there a discount for that? You go down your entire list. Methodically, politely. Don't let them rush you. By doing this, you might uncover 1 or 2 discounts that were never applied, which can add up to significant savings. If after all this, the price is still not where you want it, you move to the next phase, adjusting your policy. But you do it intelligently. Your script is, okay, we're getting closer. Let's look at my actual coverage. Right now, my collision and comprehensive deductibles are both at $500. If I were to raise them both to $1,000, how much would that save me annually? Could you run that number for me? This demonstrates that you understand how insurance works. A higher deductible means lower premiums. For many seniors with a good driving record and an emergency fund, Raising a deductible from $500 to $1,000 is a smart financial trade-off. You might also ask about dropping optional coverages you don't need, like rental car reimbursement if you have a second vehicle. Finally, after you've tried everything, you ask the magic question. This is the last arrow in your quiver. Thank you for being so patient and working through this with me. I have one last question for you. After all the adjustments and discounts we've discussed, is this new price of new quoted price the absolute best you can offer to keep your loyal customer? This simple, direct question often triggers a final check. It forces the agent to confirm they have exhausted all options. Sometimes a customer loyalty credit magically appears at this stage. But what if they still won't budge and the price isn't right? What if they say, "I'm sorry, that's the best we can do"? You have one final play. Your response: "I understand. I really would prefer not to go through the hassle of switching, but the savings with competitor company are just too significant to ignore. Before I make my final decision, is there any possibility of speaking with someone in your customer retention department? Perhaps they have other options available." The retention department is where they send customers who are about to cancel. Their entire job is to save your business. They have access to deals and discounts that regular agents don't. Asking to be transferred there is your ultimate trump card. It tells them you are literally one step from walking out the door. More often than not, this is where you'll get the best possible offer. Once you've agreed on a new price and you will confirm everything. "That's fantastic, thank you. That new price works for me. Could you please email me a confirmation of the changes we made to my policy and the new annual premium for my records?" Always get it in writing. This entire process might take 30 minutes on the phone, but those 30 minutes of calm, prepared, and strategic conversation can save you hundreds, even thousands of dollars over the next few years. You've now gone from being a price taker to a price maker. You've demonstrated that you're an informed, savvy consumer who knows their worth. But what if you switch? What does that process look like? And how do you do it without any lapse in your coverage, which is critically important? That's the final piece of the puzzle we'll assemble in our next section. Making the switch seamlessly and safely. Alright, you've done the hard work. You've shopped around, you've compared quotes, you've found a policy that saves you money without sacrificing the coverage you need. Now comes the moment of truth. Pulling the trigger. This is where a lot of people get nervous, and for good reason. The fear of making a mistake, of accidentally creating a gap in your coverage, is very real. A single day without insurance can have catastrophic financial consequences. But I'm going to give you a precise step-by-step roadmap that eliminates that risk completely. Think of it less like jumping from one moving train to another, and more like building a new, better bridge right next to the old one, and then calmly walking across when it's complete. The single most important rule, the golden rule of switching car insurance, is this. You must have your new policy fully active and in force before you cancel your old one. Never ever cancel your existing policy first, hoping to time the new one perfectly. That is a recipe for disaster. The goal is to have a slight overlap, even just for a day rather than a gap. An overlap might cost you a few dollars. A gap could cost you everything. So here is your 7-step guide to making the switch safely and seamlessly. Step 1. Purchase and activate your new policy. You've gotten the quote, now it's time to make it official. You'll go through the final application either online, over the phone, or with an agent. You will provide your payment information and, most importantly, you will choose the effective date. This is the date your new coverage officially begins. A smart strategy is to set the effective date of your new policy to be the exact same day that your old policy is set to be canceled. Or, for total peace of mind, set it for the day before you plan to cancel your old one. Once you've paid, you should receive immediate confirmation, including a policy number and digital proof of insurance. Do not proceed to the next step until you have this confirmation in your hand or in your email inbox. This document is your proof that the new bridge is built and ready. Step 2. Review your new policy documents immediately. Don't just file them away. The moment you get them, open them up and play detective. You're looking for accuracy. Is your name spelled correctly? Is your address right? Are the vehicle identification numbers, the VINs, for all your cars listed correctly? A single wrong digit can cause major problems down the line. Most importantly, check the coverages and deductibles. Do they match the quote you were given? Are the liability limits what you asked for? Is the comprehensive deductible $500 like you wanted, or did it get entered as $1,000? And finally, check for your discounts. Is the mature driver discount there? The bundling discount? The low mileage discount? It is far easier to correct a mistake on day one than it is on the day you need to file a claim. If you find any discrepancies, call your new insurance company immediately to get it corrected and have them send you revised documents. Step 3. It's time to cancel the old policy. Now, and only now, with your new policy confirmed and verified, do you contact your current insurer. You can usually do this over the phone, through their online portal, or by sending a formal letter. The phone is often the most direct way. When you call, be polite but firm. You don't need to give a long-winded explanation. You simply need to state your intention clearly. A good script is, "Hello, my name is your name, and my policy number is your policy number. I have secured coverage with a different provider, and I need to cancel my policy effective date." This is a critical point. You are in control of the cancellation date. You tell them the date. To avoid any confusion or overlap billing, the ideal cancellation date for your old policy is the same date that your new policy becomes effective. So if your new policy starts at 12:01 a.m. on June 15th, you tell your old company to cancel your policy effective June 15th. This ensures a seamless transition. They may try to win you back, offer you a better rate. You can listen, but if you've done your homework, you know the deal you're getting is better. Just politely stick to your decision. Step 4. Get written confirmation of the cancellation. This is non-negotiable. Do not hang up the phone or leave the website until you have a cancellation confirmation number, or, even better, an email or letter confirming that your policy has been canceled and the date it is effective. This document is your proof. It protects you if the company makes a billing error and tries to charge you for the next month, or worse, sends you to collections for non-payment on a policy you thought was canceled. Without written proof, it's your word against their automated billing system. You want that proof. Step 5. Look for a prorated refund. If you paid for your old policy in full for a 6-month or year-long term, you are entitled to a refund for the unused portion. This is called a prorated refund. For example, if you paid for a 6-month policy and you cancel exactly 3 months in, you should get about half your money back. Some companies, though it's less common now, may charge a small cancellation fee. This would have been outlined in your original policy documents. Your refund should typically arrive within a few weeks. If you don't see it, follow up with a phone call, referencing your cancellation confirmation number. Step 6. Notify your lien holder. This is a crucial step that many people forget. If you have a loan or a lease on your vehicle, your lender is listed on your insurance policy as the lien holder or loss payee. Your loan agreement requires you to maintain continuous insurance coverage to protect their investment. When you switch insurers, you must notify them of the change. Your new insurance company may offer to do this for you, but it's wise to verify it's been done. The easiest way is to call your lender's customer service line, or to send them a copy of your new policy's declarations page, which lists all your coverage details and shows them as the lien holder. Failing to do this can put you in breach of your loan contract. The lender could, in a worst-case scenario, purchase very expensive insurance on your behalf, called force-placed insurance, and add the cost to your loan payment. It's a simple step that prevents a massive headache. Step 7. The final handoff. Print out your new insurance ID cards. Take the old ones out of your wallet in your glove compartment and replace them with the new ones. It's a small physical action, but it signifies the completion of the process. You've successfully navigated the switch. So let's recap the biggest pitfalls to avoid. The cardinal sin is the coverage gap. You avoid this by buying the new policy before canceling the old one. The second mistake is assuming your old policy will just expire. Most policies are set to auto-renew, so you must proactively cancel it to stop the billing. The third is forgetting to notify your lender, which can have serious financial consequences. And finally, the fourth is accepting a verbal cancellation without getting written proof. Always get it in writing. By following these 7 steps, you transform a potentially stressful process into a simple, manageable checklist. You take control, you eliminate risk, and you put yourself in the driver's seat of your financial well-being. You've now mastered the art of comparison shopping, finding the right discounts, and executing a flawless switch. You've done the work, and you're likely saving a significant amount of money. But the journey doesn't end once the switch is made. Insurance isn't a set-it-and-forget-it product, especially as our driving habits and needs change. What happens when you actually need to use it? What does the claims process look like? And are there different considerations for senior drivers? And how often should you repeat this process of shopping around to make sure you're always getting the absolute best value? We'll cover how to manage your policy for the long term and how to navigate the claims process with confidence in our next section. The conventional wisdom with insurance is often, set it and forget it. You do the hard work, find a good policy, and then you just let the automatic payments roll. But in reality, treating your auto insurance like a subscription you never review is one of the fastest ways to overpay. So, to answer that critical question, how often should you be shopping around? The golden rule is to review your policy and get competing quotes at least once a year, typically about 30 to 45 days before your policy is set to renew. Think of it like an annual financial checkup. The insurance landscape is constantly shifting. Insurers change their rates, new discounts emerge, and your own life circumstances evolve. What was the perfect fit for you last year might be a terrible deal this year. Beyond that annual checkup, there are several key life events that should act as an immediate trigger to pick up the phone and reassess your coverage. These are moments where your risk profile, in the eyes of an insurer, has changed dramatically, and that change should be reflected in your premium. The first and most significant for many of us is retirement. The day you stop commuting to work 5 days a week is the day your annual mileage plummets. You've just gone from a standard or even high mileage driver to a low mileage driver. This is a massive change that can unlock substantial discounts. If you don't tell your insurer, they won't know, and you'll keep paying as if you're still battling rush hour traffic every day. Another major trigger is moving. Relocating to a new zip code, even just a few miles away, can have a huge impact on your rates. Insurance premiums are heavily based on location-specific data, like traffic density, theft rates, and weather patterns. Moving from a dense urban center to a quiet suburban or rural area could lead to a significant price drop. Conversely, moving to a busier area might increase your rates, making it even more important to shop around to find the insurer who views your new location most favorably. Buying a new car is an obvious one. The make, model, and year of your vehicle are cornerstone factors in your premium. A new car will have different safety ratings, repair costs, and theft statistics than your old one. You'll need to update your policy immediately to ensure the new vehicle is covered. And this is the perfect opportunity to see if another company can offer a better rate for that specific car. Changes in your household are also critical. Did you recently get married? Married individuals are statistically safer drivers and often receive lower rates. It's essential to ask about a marriage discount. Are you adding or removing a driver from your policy? Perhaps a grandchild is now licensed and will be borrowing your car occasionally, or maybe a spouse has stopped driving. Any change to the list of insured drivers on your policy demands an immediate review. Finally, watch for the red flags from your current insurer. If you receive your renewal notice and the premium has jumped by 10, 15, or 20% with no clear explanation, no accidents, no tickets on your record, that is your signal. That is the market telling you it's time to shop. Don't just accept a steep increase out of loyalty. Loyalty is a two-way street, and your first loyalty should be to your own budget. Managing your policy is the preventative care. But what happens when the unexpected occurs? What happens when you actually have to use the insurance you've been paying for? For most people, a car accident is a disorienting and stressful event. Having a clear plan of action can make all the difference, turning a moment of chaos into a manageable process. Let's walk through it step by step. The absolute first priority at the scene of an accident is safety. Before you even think about insurance, check yourself and your passengers for injuries. If anyone is hurt, or if you're unsure, call 911 immediately. If your car is drivable and it's safe to do so, move it out of the flow of traffic to the shoulder of the road to prevent another collision. Turn on your hazard lights. Once you've ensured everyone is safe and help is on the way if needed, your next job is to become an information gatherer. This is not the time to be shy. You need to exchange information with the other driver. Get their full name, address, phone number, and their insurance company name and policy number. Politely ask to see their driver's license and insurance card to verify the information. Use your smartphone to take a picture of both documents. While you're at it, turn your phone into your best witness. Take photos of everything. Document the damage to both vehicles from multiple angles, close up and from a distance. Take pictures of the other car's license plate. Capture the wider scene of the accident, road conditions, traffic signs, skid marks, weather. If there are any witnesses, ask for their names and phone numbers. Their objective account can be invaluable. Now, here's what you must not do at the scene. Do not admit fault. Even a simple apology like "I'm so sorry" can be interpreted as an admission of guilt later on. Stick to the facts of what happened. Do not argue with the other driver or discuss the details of the accident with them. Your conversation should be limited to exchanging essential information. And never, ever agree to a private settlement on the spot. The other driver might offer you a few $100s in cash to avoid involving insurance, but you have no idea what the true extent of the damage is, or if you'll feel the effects of an injury like whiplash hours or days later. Always go through the proper channels. Once you are safely home, it's time to report the incident. Contact your insurance company as soon as possible. Most insurers have a 24/7 claims hotline, a mobile app, or an online portal. Provide them with all the information you meticulously collected at the scene. Be honest and stick to the facts as you know them. The insurer will open a claim and assign you a claim number. Write this down. You'll then be assigned a claims adjuster. It's important to understand the adjuster's role. They work for the insurance company. Their job is to investigate the accident and determine the company's financial liability. While they should be professional and helpful, they are not your personal advocate. Their goal is to settle the claim efficiently and in accordance with your policy and the company's guidelines. The adjuster will begin their investigation. They'll review your statement, contact the other driver and witnesses, and look at the police report if one was filed. They will also need to assess the damage to your vehicle. The insurance company will likely have a network of preferred auto body shops they work with. You can take your car to one of these shops for a quick and streamlined estimate. But remember, you have the legal right to take your car to any repair shop of your choosing. If you have a trusted mechanic you've worked with for years, you are entitled to get an estimate from them. After the investigation and appraisal, the adjuster will determine who was at fault and explain how your policy will cover the damages. If the repairs are approved, the insurance company will pay the body shop directly, minus your deductible. You are responsible for paying your deductible amount to the shop. Sometimes, the damage is so severe that the cost to repair the car is more than the car is worth. In this case, the insurer will declare it a total loss. If this happens, they won't pay for repairs. Instead, they will pay you the actual cash value or ACV of your vehicle. This is a critical point of confusion for many people. The ACV is not what you paid for the car, nor is it the cost to buy a brand new one. It is the market value of your car the moment before the accident occurred, taking into account its age, mileage, and condition. This is also a point where you can and should advocate for yourself. If the insurance company's ACV offer seems too low, don't just accept it. Do your own research. Find recent sales listings for cars of the same make, model, year, and condition in your local area. Present this evidence to the adjuster, and be prepared to negotiate for a fair value. The first offer is just that, an offer. Throughout this entire process, from the first phone call to the final settlement check, keep meticulous records. Start a dedicated folder or notebook. Write down the name and contact information of every person you speak with, the date and time of the conversation, and a summary of what was discussed. Keep copies of all emails and documents. This paper trail is your best defense against confusion and disputes. Be patient, but also be persistent. The claims process can take time, but it's okay to follow up politely with your adjuster to ask for status updates. By being prepared, organized, and informed, you transform yourself from a victim of circumstance into an active, confident participant in your own financial recovery. And that confidence is the ultimate goal. It's the final piece of the puzzle that transforms auto insurance from a source of anxiety into a tool for security. Now that we've walked through the entire process, from understanding coverages to navigating a claim, let's bring it all together. Let's talk about the long game. How you maintain this newfound control and adapt to a world that is constantly changing. This is about shifting from a reactive mindset to a proactive one. You no longer have to wait for a bill to arrive or an accident to happen to think about your insurance. You are now the one in the driver's seat, in every sense of the word. The single most important habit you can build is the annual policy review. Think of it like an annual checkup with your doctor. You don't wait until you're sick to go. You go to make sure you stay healthy. Your insurance policy is the same. Once a year, about 45 days before your renewal date, set aside an hour. Pull out that declarations page we talked about. Look at your coverages. Look at your deductibles. Ask yourself, what has changed in my life this past year? Did I retire? Am I driving significantly less? Did I sell a car or buy a new one? Did my spouse pass away, changing who drives the household vehicles? Have I taken a defensive driving course? Every single one of these life events is a potential reason to adjust your policy and very likely save money. Don't assume your insurance company knows or will automatically apply discounts. The two most expensive words in insurance are, "I assumed." You have to be your own advocate. Call your agent or company and have a conversation. Say, "I'm doing my annual review, and I want to make sure I have the best coverage for the best price based on my current situation." You'll be amazed at how that one proactive phone call can put hundreds, sometimes thousands, of dollars back into your pocket over time. This isn't about being cheap. It's about being a smart steward of your resources. Now let's look over the horizon, because the world of auto insurance is changing faster than ever before, driven by technology. You've probably heard about things like telematics or usage-based insurance. These are programs where you either plug a small device into your car or use a smartphone app that tracks your driving habits. Things like how fast you accelerate, how hard you brake, the time of day you drive, and how many miles you cover. The promise is simple. If you're a safe driver, you can earn a significant discount. For many seniors who are retired, drive less, and tend to be cautious on the road, this can sound like a fantastic deal. And for many it is. But it's crucial to go into it with your eyes wide open. First, ask about the specifics. What exactly is being tracked? Some people have privacy concerns, and that's perfectly valid. You have to decide your comfort level with a company monitoring your movements. Second, ask how the data is used. Will my rates go up if I have a few instances of hard braking to avoid a deer or a distracted driver? Some programs only offer discounts, while others can actually penalize you. Understand the rules of the game before you agree to play. Third, consider your driving patterns. If you regularly drive late at night or your routes involve a lot of stop-and-go city traffic that can lead to more hard-braking events, these programs might not work in your favor. However, if you're a low-mileage driver who sticks to daytime hours and local roads, you could be the ideal candidate for major savings. The key, as always, is to ask questions and understand the trade-offs. Don't just say yes to the first offer. Ask for details, compare it to your traditional policy, and make an informed choice. This technology is becoming more and more common, and understanding it now puts you ahead of the curve. Another major shift is the increasing complexity of cars themselves. We're not just driving mechanical machines anymore. We're driving computers on wheels. Features like adaptive cruise control, lane keeping assist, and automatic emergency braking are incredible safety innovations. They are proven to reduce accidents, and insurance companies know this. When you're shopping for a new car, or even when you're reviewing your policy for your current car, make sure your insurance company knows about every single safety feature it has. Many insurers offer specific discounts for these technologies. It might be a 5% discount here, a 3% discount there, but they add up. Again, never assume they know. List them out. Your car's safety features are a key part of your risk profile, and you deserve to be rewarded for investing in a safer vehicle. But beyond the technology and the discounts, let's talk about something even more important: your legacy. How you manage your auto insurance is part of the financial house you keep in order, and it has a direct impact on the people you love most, especially your spouse. If you are the person who has always handled the insurance, the bills, the renewals, what happens if you're suddenly unable to? Will your spouse know who to call? Will they know where the policy documents are? Will they understand the coverages you've chosen and why? This isn't a comfortable conversation, but it is a profoundly loving one. Take the time to sit down with your spouse or a trusted adult child. Walk them through your policy. Show them the declarations page. Put your agent's name and phone number, along with your policy number, in a place where they can easily find it. Create a simple file, physical or digital, with your insurance ID cards, the policy document, and any relevant contact information. This single act of organization can lift an immense burden from your family during an already stressful time. It's a gift of clarity and peace of mind. Think about details too. If you have medical payments coverage or personal injury protection, have you designated a beneficiary? In the tragic event of a fatal accident, this can ensure that those benefits are paid out quickly to your spouse or estate, without having to go through a lengthy legal process. Check your policy, and ensure that both you and your spouse are listed as named insureds on the policy, not just as drivers. This gives both of you equal authority to make changes, file claims, and manage the policy. It's a small detail that provides crucial flexibility and protection for the surviving spouse. This isn't just about car insurance. It's about a legacy of care. It's about ensuring the person you've shared your life with is protected and empowered, even if you're not there to guide them. So here we are at the end of this journey together. We started with the confusing jargon on a declarations page and have traveled all the way to planning for the future and protecting your family. You've learned how to choose the right coverages, how to find every last discount, what to do in the critical moments after an accident, and how to confidently manage a claim. You are no longer just a policy number or a customer. You are an informed consumer, a prepared driver, and the chief financial officer of your own life. The power is, and always has been, in your hands. Insurance companies can seem like giant, faceless corporations, but at the end of the day, they are providing a service you are paying for. You have the right to ask questions. You have the right to good service. You have the right to shop around and take your business elsewhere if you're not being treated with the respect you deserve. I want to leave you with a simple 3-step action plan you can take right now, today, to put all this knowledge to work. First, find your most recent auto insurance policy declarations page. Just pull it out. Second, look at your calendar and schedule a 30-minute appointment with yourself 1 month before it renews. Title it Car Insurance Review. Third, and this is the most important step, turn to your spouse or pick up the phone and call your son or daughter and say, "I want to take a few minutes to walk you through our auto insurance, just so you know where everything is." That's it. Those 3 small steps will set in motion a chain of events that will save you money, reduce your anxiety, and protect your family for years to come. You've spent a lifetime gaining experience, wisdom, and perspective. This is simply one more area of your life where you can apply that wisdom to your great advantage. Knowledge isn't just power, it's peace of mind. Go forward with confidence, knowing you have the tools you need to navigate the road ahead, safely and securely.